Picture this. You open your phone, check the silver price, and you feel that familiar comfort of, okay, that's the market. Then you swipe once, look at Shanghai, and silver is trading higher. Not by a few cents, higher enough to make you stop and think, wait, why would the same metal have two different prices at the exact same time? And here's the scary part. That gap isn't just a fun trivia fact. It can be a pressure crack in the paper price system, and when those cracks widen, things can move fast. If you like simple story-style breakdowns of what's really happening behind the numbers, take 1 second to hit like and subscribe right now. I post updates that connect the dots without all the confusing jargon, and it really helps the channel reach more people who are trying to understand what's going on. Now let's slow down and talk about the Shanghai gap, because most people hear it and assume it's just normal regional pricing. But the more you understand the plumbing of silver, the more you realize this can be a signal, not always a guarantee, not a prophecy, and definitely not financial advice, but it can be a signal that physical demand is tugging on the supply chain while paper markets are trying to pretend everything is perfectly balanced. Let me tell you a quick story that explains why this matters. Imagine you walk into two grocery stores in the same city. In one store, eggs are normal price. In the other store, eggs are noticeably higher and the shelves are thinner. If you're smart, you don't just say, oh, well, different store. You ask, is the second store seeing a supply issue first? Is something changing behind the scenes? And with silver, Shanghai can sometimes look like that second store, because a lot of trading there is tied more directly to real metal moving through real hands. So what does it mean when silver trades higher in Shanghai? At the simplest level, it means buyers there are willing to pay more right now for access to metal. That could be because demand is stronger, supply is tighter, or because bringing metal into that market isn't as easy as people assume. And that last part is the one detail most people miss. Everyone hears arbitrage and thinks, easy money, buy cheap in New York, sell high in Shanghai, gap disappears. In real life, that trade is full of friction, delays, paperwork, rules, shipping costs, refining standards, taxes, and timing risk. And when the system is stressed, that friction gets worse, not better. Here's where the paper price comes in. In the West, a huge amount of silver trading happens as paper claims, futures contracts, options, unallocated accounts, synthetic exposure. It's not automatically evil, it's just the way modern markets work. But paper markets can create the feeling of infinite supply because contracts can be created faster than physical metal can be mined, refined, shipped, and delivered. Physical silver is heavy, slow, and limited. Paper silver is fast and unlimited. And when physical demand spikes in a place like Shanghai, it tests how real the available supply actually is. Shanghai's silver market, especially through the Shanghai Gold Exchange ecosystem, is often described as more physical forward. That doesn't mean there's zero paper trading. It means the pricing can reflect real deliverable conditions more quickly. When Shanghai bids up the price, it's like a live signal saying, metal is wanted here, now. And if that signal stays on for long enough, the rest of the world has to respond, because silver is a global commodity. You can't keep two separate realities forever. But let's get practical. Why might Shanghai be paying more? One reason is simply demand. China is deeply involved in manufacturing chains that use silver, electronics, soldering, medical applications, and especially solar. Silver demand tied to industrial use doesn't always behave like investment demand. Factories don't buy silver because a chart looks bullish. They buy because they need it to produce goods, and delays can cost real money. When industrial demand is steady and supply isn't flexible, price pressure shows up where the buying is most urgent. Another reason is local supply constraints. Even if silver exists somewhere in the world, it doesn't mean it can appear instantly in the form, purity, and location that a buyer needs. Bars have to meet standards. Metal needs to be in the right place, in the right vaulting system, cleared through the right channels. If import rules tighten, if quotas change, if shipping gets more expensive, if refineries are backed up, or if financing conditions shift, then that simple arbitrage becomes slow and risky. And when it becomes slow and risky, the premium can persist. Now here's where the story turns into something more serious, a persistent Shanghai. Premium doesn't just say China demand is strong. It whispers something bigger. The physical market may be tighter than the paper price suggests. Because if the paper price truly reflected abundant supply, metal would rush to capture the premium until it disappeared. The only reason a meaningful premium can stay alive is because moving metal is constrained, or because available metal is not as available as the screen price implies. Now let's talk about that screen price for a second. And when people say silver price, they usually mean a futures-driven reference price. That price is incredibly influential, but it's not the same thing as what does it cost to get real silver in your hands this week? If you've ever tried to buy coins or small bars during a hot market, you already know the feeling. The spot price is one thing. The actual price you pay after premiums and availability is another. That difference is the physical world pushing back on the paper world. And Shanghai is basically a giant version of that same concept. It's a massive physical demand center saying, this is what silver costs here right now. If that price stays higher, it becomes a magnet. Metal wants to flow toward the higher price because global traders and suppliers notice. But the path from I notice to I deliver is filled with bottlenecks. Now I want to address a question I know you're thinking. If Shanghai is higher, does that automatically mean the paper price will break or spike? Not automatically. Sometimes the gap closes because Shanghai cools off. Sometimes currency moves make the gap look larger or smaller. Sometimes there's a temporary event like a holiday demand surge. Sometimes the gap exists because local conditions create a one-off premium. So no, it's not a guaranteed trigger. But here, that's why people watch it closely. When the gap is paired with other stress signals, it can become part of a bigger pattern. And patterns are what move markets. So what are those other stress signals? Think of them like clues in a mystery. One clue by itself is interesting. 5 clues together can change the whole story. Clue 1 is the behavior of physical premiums outside Shanghai. Are delivery times getting longer? Waiting? If the Shanghai premium is up and US premiums are also sticky, that's global physical tightness showing through in multiple places. Clue 2 is what happens in the futures market structure. You can sometimes see unusual spreads between near-term and longer-term pricing because immediate metal becomes more valuable than metal later. That's the market. If that kind of urgency shows up while Shanghai is paying up, the pressure increases. Clue 3 is lease rates and borrowing costs in the precious metals world. You don't need to be an expert here. When something is scarce, borrowing gets expensive. Rising stress in those plumbing. Clue 4 is vault movements and inventory trends. Again, we're not doing hype, but when the direction is persistently down in key places, it can reinforce the idea that the system is being drained by steady demand. And Clue 5 is what I call policy and pipeline friction. This is the least talked about, and it's the rules, taxes, import controls, financing rules, and people. But silver is not. And this is where the paper price break idea becomes more than a dramatic phrase, a way that keeps the reference price credible. Most of the time, that's fine. The system can defend itself by widening spreads, increasing margin requirements. That doesn't all. One price, physical becomes another, and the public slowly realizes the price is not a single truth anymore. So if you're asking, what would it actually look like if the gap starts breaking the paper price? Let's paint 3 realistic scenarios, and I want you to listen closely because the third one is the one that catches people off guard. Scenario 1 is the boring close. Shanghai premium fades. Demand softens or supply loosens locally, maybe due to timing or policy. The gap shrinks and everyone stops talking about it. This happens sometimes, and it's why you never want to base your whole worldview on one data point. Scenario 2 is the bullish close. The global price rises to meet physical reality. In this scenario, Western pricing starts climbing because more buyers want real metal, or because suppliers refuse to sell at paper levels, or because industrial demand stays strong. The gap closes because the reference price moves up. Scenario 3 is the messy close, and this is the one I want you to remember. The gap doesn't close cleanly. Instead, the market solves the problem by making physical harder to access at the paper price. Premiums rise, delays increase, spreads widen. More people get pushed into substitutes like ETFs or unallocated exposure because getting bars is slow or expensive. Paper still trades, but it begins to feel disconnected from the lived reality of buyers who actually need metal. This is how confidence erodes, not overnight, but steadily until one day the reaction is sharp. Now let's talk about why Shanghai matters specifically in that messy scenario. Because Shanghai can act like a persistent bid that drains available global supply over time. If metal consistently finds its way east due to higher pricing and steady demand, it can quietly tighten the float elsewhere. Western markets can look fine right up until they don't. It's like watching a lake level drop. One day you don't notice, then suddenly boats can't launch. And this brings us to the biggest misconception in silver. People think the market is mainly about investors. But silver is not only a monetary metal, it's also an industrial input. That means even if investors get nervous and pause, industrial demand can still keep pulling. And when supply is constrained, that pull shows up as higher prices, where the demand is strongest. Let me also say something clearly, because I want this video to be useful, not panic-driven. A higher Shanghai price doesn't mean you should rush into anything. It doesn't mean a squeeze is guaranteed. It doesn't mean tomorrow will be chaos. What it does mean is you should pay attention to where real demand is showing up, and whether that demand is persistent. If you want to track this like a calm, smart observer, here's the mindset. Don't stare at one number. Watch the relationship between numbers. Watch the gap. Watch how long it lasts. Watch whether it widens during pullbacks or only during rallies. Watch whether physical premiums stay firm even when the paper price dips. That's the kind of behavior that can reveal stress. Because think about it. If paper price drops but physical premiums don't, what is the market telling you? It's telling you that sellers aren't responding to the paper signal, or that buyers are still there regardless of paper. That's when the screen price starts to feel more like a headline than a clearing price. Now, I promised earlier there's one detail most people miss, and here it is, plain and simple. The gap is not just about China paying more. The gap is a stress test of delivery. It's a real-time test of whether the global system can move enough metal fast enough in the right form without breaking something. When the system is healthy, premiums invite flow and the gap compresses. When the system is strained, the premium can become a stubborn warning light. And the reason this can break the paper price is psychological as much as mechanical. Markets run on confidence. If enough participants believe physical is tight, paper can become less trusted as a price signal. That's when you can see sudden repricing events, not because a computer decided it, but because people demanded different terms. Higher premiums, faster delivery, stronger guarantees, or they walked away until price adjusted. So what should you watch next, specifically, if you want to stay ahead of the story without getting lost in noise? Watch whether Shanghai stays elevated for weeks, not days. Watch whether industrial demand headlines are backing it up. Watch whether U.S. retail availability tightens at the same time. Watch whether delivery times and premiums act like the market is tighter than the charts suggest. And watch whether volatility increases around key price levels, because that's where paper and physical narratives tend to clash. And here's a question I want you to consider, because it's the heart of this whole topic. If silver is truly abundant, why would a major global hub consistently pay up for it? That doesn't mean the end is here. It just means the physical market is speaking, and it's worth listening. Before we wrap up, I want to bring this back to the real world, especially for a U.S. audience. In the U.S. Toyo, most people experience silver through a price quote and a buy button. But if you've ever tried to buy during a surge, you know the truth. Availability matters. Premiums matter. Delivery matters. The Shanghai gap is the global version of that same lesson. The quote is not always the full story, and this is why I love covering topics like this in a storytelling way, because it's easy to get lost in charts and forget what a market actually is. A market is people, its needs, its constraints, its incentives. And sometimes it's fear, sometimes it's urgency. When Shanghai pays higher, it's a visible incentive, and incentives move metal. Now I want to hear from you, because your on-the-ground experience is part of the data. In the comments, tell me what you're seeing where you live. If you've checked silver recently, are dealer premiums calm, or are they stubbornly high? And do you think the Shanghai premium is a temporary local effect, or a bigger warning sign about physical supply? I read the comments, and it helps shape what I cover next. Also, if you found this explanation helpful, please share this video with one friend who follows markets but still thinks the silver price is just one simple number. Sharing helps more than you think, because it pulls people into the conversation before the headlines get dramatic. And if you stayed with me to the end, here's the final takeaway I want you to remember the next time you see that Shanghai price print higher. Don't just ask, is silver going up? Ask, where is real demand showing up, and how hard is it for the system to deliver? Because when a gap keeps showing up in a market that's supposed to be globally connected, it's not random, it's information. And the people who pay attention to information early are usually the ones who stay calm when everyone else finally notices. If you want me to do a follow-up where I break down the exact signals to watch week by week and how to interpret the gap when price is rising versus falling, tell me in the comments. And make sure you're subscribed so you don't miss it, because this story doesn't end with one Shanghai print. It ends when the gap either closes or forces the rest of the world to admit what physical buyers already know.